Good morning, everyone. Today we're bringing you some truly remarkable news from the heart of London's financial district. A day that will be remembered in the city's economic history. Yesterday, the London stock market achieved a milestone that has captured the attention of investors and analysts around the world. The city was buzzing as the news broke, with excitement rippling through trading floors and financial newsrooms alike. The FTSE 100, which tracks the largest companies listed in London, closed at a record 10,126.6 points. That's an impressive 0.8% jump in just one day, reflecting a surge in investor enthusiasm and confidence. This achievement marks the second consecutive week of gains for the FTSE 100, reinforcing the sense that the UK's economic outlook is strengthening. Traders celebrated on the floor, and analysts pointed to a renewed optimism that's been building over recent months. But the excitement didn't stop at London's borders. Across Europe, the Pan-European STOXX 600 index also soared to an all-time high, highlighting a wave of positive sentiment that's sweeping through the continent's markets. When we see major markets like these rising in tandem, it's often a sign that powerful global forces are at play, factors that can influence economies and investments far beyond Europe. So, what's behind this impressive rally? A combination of strong earnings reports from leading companies, encouraging economic data from the United States, and a general sense that the global economy is on a firmer footing. In the next few minutes, we'll break down the key drivers behind this surge, looking at the companies making headlines, the economic indicators that matter, and what it all means for investors and everyday people alike. Stay with us as we dive deeper into the stories and trends shaping this record-breaking moment for London and beyond. The biggest headline yesterday? Glencore's shares skyrocketed nearly 10%, their highest since mid-2024. The reason reports that Glencore is in merger talks with mining giant Rio Tinto. This potential deal would unite two of the world's largest mining companies, sending shockwaves through the industry. Investors rushed to buy Glencore shares, betting on a future mining powerhouse. A merger of this scale could mean greater efficiency, more market power, and bigger profits. While talks are still early, the market's reaction shows just how much is at stake. It's a classic case of big news driving big moves. The financial world is watching closely. If Glencore and Rio Tinto were to merge, the result would be nothing short of historic. Together, they'd create the world's largest mining group, with a staggering combined value of nearly $207 billion. This isn't just a big deal for the companies involved, it's a seismic shift for the entire mining sector and global markets. Investors, analysts, and industry insiders are all watching closely, as such a merger would instantly reshape the competitive landscape. This new mining giant would control an enormous share of the world's most critical resources, from iron ore and copper to coal and nickel. With such vast holdings, the merged company could influence commodity prices on a global scale, affecting everything from construction costs to the price of electronics. The ripple effects would be felt by manufacturers, governments, and consumers worldwide, as the balance of power and resource supply shifts dramatically. The merger could unlock major cost savings and operational efficiencies as the two companies combine their expertise, technology, and supply chains. Streamlining operations could mean higher profits and a stronger position in negotiations with buyers and suppliers. But it's not just about the bottom line. This deal would fundamentally reshape the mining industry, forcing other players to rethink their strategies and alliances. Competitors might scramble to keep up, considering their own mergers or partnerships to stay relevant. Meanwhile, financial regulators around the world would be on high alert, watching for any signs that the new supergroup could wield too much control over the market. Antitrust concerns and regulatory hurdles could become major obstacles, as authorities weigh the risks and benefits for consumers and the global economy. For Glencore, this is more than just a business deal. It's a bold move to diversify its portfolio and strengthen its position on the world stage. The company would gain access to new markets, resources, and expertise, making it a true powerhouse in the industry. The buzz around this potential merger is intense, with many calling it the creation of a mining superpower that could set the tone for years to come. The stakes couldn't be higher. As the world watches, the outcome of this merger could redefine not just the mining industry, but the future of global resource management. Here's the twist. While Glencore soared, Rio Tinto's shares dropped 3%. Why? Investors worry the deal might favor Glencore, or that Rio Tinto could lose its independence and unique culture. Some fear Glencore's aggressive style could clash with Rio Tinto's traditional approach. Regulatory hurdles also loom large. A merger this big would face intense scrutiny. The uncertainty makes some investors nervous, leading to a sell-off. In big deals, the buyer often gets a boost, while the target faces doubts. It's a reminder, every merger has winners and losers. The market is weighing the risks. The London rally wasn't just about mining. Key news from the US played a huge role. In today's interconnected financial world, what happens in one major economy can send ripples across the globe, and this week was a perfect example. Investors in London were closely watching developments across the Atlantic, knowing that the US jobs report could set the tone for markets everywhere. December's US jobs report showed slower job growth than expected. While that might sound like a setback for the American workforce, for global investors, it was a signal that the red-hot US economy might finally be cooling off. Fewer new jobs means less pressure on wages and prices, which is exactly what central bankers have been hoping for. Paradoxically, this was good news for markets. It suggests the Federal Reserve's high interest rates are cooling the economy, easing inflation. The Fed has been raising rates aggressively to tame rising prices, but investors have been worried that too much tightening could tip the economy into recession. This jobs report hinted at a delicate balance. Inflation is coming down, but the economy isn't crashing. Investors now hope the Fed will cut rates sooner, making borrowing cheaper and boosting business growth. Lower rates would mean easier access to credit for companies and consumers alike, potentially fueling expansion and new investment. The prospect of a rate cut is often enough to send markets soaring, as it signals a more supportive environment for growth. Lower rates are music to investors' ears. They make stocks more attractive and fuel optimism. When borrowing costs fall, companies can invest more in innovation, hiring, and expansion, which often translates into higher profits and rising share prices. For everyday investors, this can mean better returns on their portfolios and a renewed sense of confidence in the market's direction. The US jobs data sent a wave of positivity through global markets, including London. Traders and analysts across Europe and Asia quickly recalibrated their expectations, with many now betting on a more favorable outlook for the year ahead. The news didn't just lift American stocks, it boosted sentiment worldwide. When the world's largest economy hints at lower rates, markets everywhere take notice. The US dollar, global commodities, and international trade flows are all influenced by American monetary policy, so even a subtle shift in expectations can have far-reaching effects. This was a key ingredient in Friday's record rally. London's FTSE 100 surged to new highs, fueled by optimism that easier money could be just around the corner. The combination of local and global factors created a perfect storm for market gains. Sometimes, bad news is just what investors want to hear. Slower job growth may worry some, but for the markets, it's a sign that the worst of inflation could be behind us, and that central banks might soon shift to a more supportive stance. The global economy is more connected than ever. News from Washington can spark rallies in London, Tokyo, and beyond, reminding us that in today's world, financial fortunes rise and fall together. Let's dig deeper. Why do lower interest rates matter so much? After the US jobs report, traders bet the Fed will cut rates by over 0.5 percentage point in 2026. Lower rates mean cheaper loans for businesses and consumers, fueling investment and spending. For investors, low rates make stocks more appealing than savings accounts. The FTSE 100, with its global companies, is heavily influenced by U.S. rate expectations. International money chases the best returns, so optimism in the U.S. spreads worldwide. Rate cut hopes are driving a risk-on mood in markets from London to Tokyo. The ripple effect is real and powerful. Another big driver of the FTSE 100's record, the energy sector. Oil and gas companies surged 2.8% thanks to rising crude oil prices. Higher oil prices mean bigger profits for giants like Shell and BP, lifting the whole market. The rally reflects both supply concerns and expectations of strong global demand. Energy stocks are a barometer for economic health. When they rise, it signals confidence. The sector's strength added major fuel to the FTSE's climb. It's a reminder, traditional industries still matter. Energy's surge was a key part of the day's success. Not every company joined the celebration. Sainsbury's shares fell over 5% after a disappointing Christmas trading update. Non-food sales dropped, worrying investors. The news raised concerns about consumer spending and competition in retail. IAG, parent of British Airways, also slipped nearly 3% after announcing a new CFO. Leadership changes can unsettle investors, especially in key roles. Even on a record day, individual company news can buck the trend. Every stock has its own story. Winners and losers coexist in every market rally. So, what's the takeaway from this record-breaking day? The FTSE 100 surge signals strong economic confidence and optimism for growth. The Glencore-Rio Tinto merger buzz shows how companies are reshaping industries and how those moves can affect us all. U.S. jobs data and interest rate hopes highlight our interconnected global economy. Lower rates could mean cheaper loans and more opportunities for businesses and consumers. But even in a rising market, individual company stories matter. Success isn't guaranteed for everyone. Staying informed is key to navigating a world of constant change. The market story is always evolving. Are you ready for what's next?